Welcome everybody to our spring webinar where we're going to talk about macroeconomics for a bit and then get to the meat of the matter with Jackie and Tanner to talk about our spring planting situation and outlook. So to get started, I wanted to do a little thing differently because my presentation is going to be a lot about what the Fed is up to and what they might do. I'm curious as to what the crowd thinks about their intentions on cutting rates this year and how and when they might do that. So our first poll here is how much will the Fed cut rates in total in 2024 by year end? So we got three options: less than 75 basis points, 75 basis points, or more than 75 basis points. So let's see what the crowd thinks. Paul, we getting some answers? Here we go. Wow, it's a total blowout here. It's probably 90% of folks have uh, less than 75 basis points, and a handful have 75 and 0. And we had close to 100 voters there. So that was a total blowout. So this is interesting. It'll be an interesting presentation because I have a slightly different point of view. Um, so inflation, big inflation report came out this morning, but it's not the inflation metric that the Fed uses primarily. This is the CPI that came out this morning. What I'm showing here is the uh, personal consumption expenditure deflator, which they use, and they tend to look at the quarterly number because that has less fluctuation in it. So this is what inflation's looked like over the past few years. And as you can see, it's come down in the past 6 months or so, but not to the degree we hoped for. And I put my forecast last night for what the first quarter PCE deflator will be, and as confirmed by this morning and other anecdotal data, the inflation is going to tick up in the first quarter. The Fed knows this; they're aware of this. Not surprised by this morning's CPI report. If you drill down into the numbers, there were a couple things that really pushed the number a little bit higher than what people thought. One is housing expense, and the other was transportation services, particularly insurance, car insurance. So those two things pushed it up a little bit there. And remember, increasing or high interest rates, that is not going to help housing costs. We need lower interest rates um, to cut housing costs. So I don't think this morning's report has much of an influence as to the Fed's thinking. They're looking at a lot of stuff. This chart here shows real interest rates. So the short-term interest rate, 1 month interest rate adjusted for inflation. And I've put 40 years worth of data. There's something like 500 data points on this chart. Today, we're in the 92nd percentile of real interest rates, meaning there only have been higher 8% of the time. Point being, the interest rate environment that we're in right now is extremely contractionary, and it's not the way to launch an economic expansion cycle. This would be in the core of a inflation busting paradigm, which I don't think the Fed is of that mindset right now. They feel like we've come out through the worst. Inflation is not what we want, but it's gonna ease over time. And we don't want to crush this recovery that we're having right now and send us into a recession. Um, Couple things the Fed is looking at besides inflation. First off, everybody's saying the labor market is fantastic. but there are some cracks in the foundation here. Take a look at U4 unemployment. That's the green line. That includes unemployed plus underemployed people. So we see a definite trend upward over the past year in those claiming unemployment, or they are underemployed, meaning they'd rather have more hours, a better job, so forth. Also look at job openings, continued deterioration there, still slightly above long-term average, but the trend is clearly visible that the labor market is weakening by the month. And workers sense this. This came out last week, I think, poll of workers. Do you expect to lose your job in the next 6 months, I believe it is? So you see a big spike over the past few months there in workers that are concerned about losing their job. Disposable income, so primarily, wages or income plus government uh, support programs makes up the bulk of this, and I've adjusted this for inflation. So we see real disposable income has fallen now for the past few months below the long-term average growth rate, and that's a 20-year trend is the green there. So we're still growing, but below long-term trend. Atlanta's Atlanta Fed's GDP now is a really often cited metric for evaluating how the economy is running currently, and they've become well known because over the past couple of years, they've absolutely killed the blue chip consensus of economists on their predictions. They've come out to be more accurate time and time again. So to explain this chart here, over time, this shows expectations for 2024 quarter one GDP numbers. So we just finished now. We won't find out for another month or so what the real government number is. But the point being is they do this weekly. They take a poll, they do their own metrics, and going back to roughly turn of the year, Atlanta Fed GDP Now model was showing that Q1 GDP would be roughly 3 to 4%. Now, over the weeks and months, reports come out on inflation, spending, wages, all this stuff. It has generally trended more and more pessimistic. So the Atlanta Fed now thinks our GDP will be just above 2%. So my point being is they're seeing a deterioration of our economic situation. Not catastrophic by any means, but they're well aware that the economy is slowing down. Here's a weekly, the Dallas Fed does another similar thing um, as far as gauging our weekly economic index, and it's roughly in line with GDP over time. So what I'm showing now is that we've been running below economic potential now for a couple of years relative to kind of historic norms. And over the past few months, it's taken a turn for a little bit further south. So again, economy has beaten expectations. Everybody admits that. Toward the end of last year, most economists penciled in that we were going to have a recession in 2024. Now, most economists do not believe that, just the opposite. So we've outperformed very low expectations, and that is good. Like we've had a good economic situation. We're going to have a no landing type of scenario, hopefully. I mean, the Fed wants to ensure that they don't want to crush the economy any further than they already have. A little bit of historic perspective on what the economy could be versus what it is. go back to before the great global financial crisis, 2008, 9, and worker participation rate was roughly 66%. Since then, obviously, it plummeted during the pandemic, but it's recovered, and people expected that through this shakedown in the economy, people moving, working from home, remote, all these different options, finding better situations for themselves, people thought that the worker participation rate would rise above where it had been prior to the pandemic. But it seems as though it's really fizzled out, and we're even at below or close to where we were, before the pandemic, which is still roughly 5 million jobs below where we were back in 2007. So the Fed is very aware of history and knows, well, geez, this economy was this, today it's this. What are our expectations? What are our hopes, dreams, aspirations for making a name for ourselves? Fed Chair Powell is he's got a big ego. He's very confident. He's a bullish guy. He's aggressive. I think his goal is to go down in history as the guy that masterminded a tremendous recovery and set the economy on a long-term upward trajectory. I don't think his primary concern is inflation going to be 2.5% or is it going to be 3.5%? That's just my opinion. The Fed also is looking at some headwinds, one of which is energy prices, particularly oil, gas, diesel, which have obviously spiked with the Ukraine invasion, but haven't come down to where they were before the Ukraine invasion. So we're about $20 a barrel over where we spent most of the last decade. So that is a headwind to the economy. Also, the huge federal debt is driving up interest rates due to competing dollars for other investment purposes. So this chart shows federal debt as a percent of GDP and the 10-year inflation adjusted interest rate. And you can see except for the bizarre pattern during the peak of the pandemic, you can see definite correlation. Increasing debt by the government is causing interest rates to trend higher over time. So the Fed is aware of this. The Fed doesn't want interest rates to be as high as they are now. So in summary, economy has outperformed low expectations. That's good, but the Fed has higher aspirations than that. Inflation it's like a forest fire that's contained. It's not spreading massively, but it's not out yet. It's going to take more time. Fed officials have admitted in various ways that inflation is going to be a little bit higher than what we had hoped. The economy has more potential than it's showing. Real interest rates are way too high as a foundation for an economic expansionary period. It's more in a peak of a inflation busting phase, and the Fed doesn't want to be there. Now, there are a couple other things we haven't talked about that the Fed is concerned could trip up the economy. US politics is, as you know, can be completely dysfunctional. Global geopolitics with Iran, Gaza, China, Taiwan, Russia, you name it. There could be spikes in energy prices or trade embargoes. Who knows what could happen? The stock market, by many measures, might be in a bubble situation. That bubble collapses. That could drag the economy toward a recession like we saw during the dot-com bubble. Spiking oil prices. People are looking at $100 oil later this summer. We shall see. Finally, commercial real estate situation is still pretty grim, and those high interest rates make it more and more difficult for companies and banks to manage that situation. So those are just some of the things on the game board, why the Fed wants to reduce these interest rates. And I believe they will do 2 to 3 cuts. I'm sticking with 3 cuts this year, 75 basis points. So that is my prediction. I have a question here. How will the 2024 election influence the Fed's policy on interest rates? I honestly don't think they have any bearing on that. My best guess is they'll cut 25 basis points in July. That will have absolutely no effect on anything by the time the election rolls around in November. These rate cuts, they take about 2 years to fully take effect. So the rate cutting that'll happen, later this year won't show any effect by the election. So I don't think the Fed is at all, they're watching the election, but none of their actions are related to that. So with that, I'll turn it over to Tanner to discuss grain markets.
Thanks, Rob. And on that note, with this economy that's been fairly resilient, although it's slowing, that's having direct impact what's going on in the grain markets, believe it or not. If you see the chart on the screen right here, you're looking at corn prices versus the value of the U.S. dollar. Obviously, when you have an expanding U.S. economy, that's going to strengthen the value of the U.S. dollar, and that tends to be bearish on commodities. And agricultural commodities is no different. You can clearly see here there's an inverse correlation with the dollar and corn prices. Now, you can put up soybean prices, wheat prices, what have you. It's all going to show a similar relationship. So everything that Rob talked about has a direct impact on what's going on in agriculture. As much time as we'd like to put into figuring supply and demand and ending stocks and things like that, at the end of the day, it's all about money flow. On that note, money flow. This is a chart of the funds, the managed money net position. When you take the long positions held by professional money managers and subtracting their short positions, and this has been written about quite a bit this past quarter about how short the funds are in the grains. Their net short position is very large, historically large. Back in February, they have, however, been trimming that back a little bit. As you can see, the net short position across corn, wheat, and all the wheat classes has been getting slightly smaller as we head into the spring growing season. Probably what's going on here is that the funds are probably trying to trim back their exposure heading into the most volatile period in the growing season, which Jackie is going to be talking about here in a moment, when the markets start trading weather reports. And so the Fed or the funds are probably trying to pull back a little bit on their exposure here, heading into the most volatile period of the growing season. The chart you see on the screen right here is proprietary data from CoBank showing the farmer ownership of grain in commercial storage. This is data based on the borrowing base of our grain customers that report a borrowing base to CoBank. And so we've aggregated that here. Special thanks to Justin Weigel and David Portman in CoBank who take the time to put this together. It's not an easy task to do that. So special thanks to those gentlemen for making this available. And as you can see, farmers still hold a fair amount of corn as of January. Okay, at the start of last quarter, farmers owned about 29% of the corn in commercial storage. That's up from 17% last year. Soybeans, they owned 35% of the beans in storage. That's up from 23% last year. Wheat, farmers own 42% of the wheat crop in commercial storage. And that is well above last year's level of 27%. And why is the farmer so reluctant to sell? Well, I think we all know the story there. The price environment has not been great, given all the things that we know about the strong dollar and the competition that we have from South America for corn and soybean exports and the strong export competition from Russia, that's holding down corn, wheat, and soybean prices at multi-year lows, and that has really caused the farmer to be very reluctant in their selling. And that's one of the factors why we're seeing strengthening basis. The chart on the screen right now is the basis for corn, wheat, and hard red winter wheat in the U.S. Across various locations. Clearly, corn and wheat have strengthened over time. Soybeans not as much, but clearly there is a reluctance on the part of the farmer that has allowed basis to tighten up because of the farmer's reluctance of selling. Of course, there's been some demand. It's been positive, especially for corn. But mostly this appears to be a farmer supply situation. Heading into spring, where are we at with the corn and soybean ratio? Well, as you can clearly see on the chart on the right, the price ratio of soybeans to corn clearly favors soybeans. Historically, when the ratio is above 2.4, that favors soybean acreage. When it's below 2.4, that favors corn acreage. And USDA came out with their prospective plantings report at the end of March, clearly indicating that that's where we're going with about 90 million acres of corn. That was a big drop from last year. We're going to talk about that here at the end of my section. Stocks are fairly ample on corn. These are corn. The chart on the left is corn stocks as of March 1st. If you look at the chart on the right, that is usage from December 1st to March 1st. Clearly, we've seen a strong improvement in corn usage. That's domestic usage plus exports. Total disappearance is up this year compared to last year, but we're still behind in prior years. That's concerning given that we've had a record crop last fall. One of the concernings here is that we've seen the disappearance of demand from countries like China. This is a very interesting story playing out. The chart on the screen is U.S. corn export commitments. They're up across the board almost for every single country except for China. Concerning situation there. You've got more exports coming out of South America, but at the same time, you have China, we think, according to Tom Vilsack, Secretary of Agriculture for the U.S., this has to do about some of the protectionist measures that the U.S. is engaging in with farmland ownership, restricting Chinese ownership of U.S. farmland, and the Chinese are not happy about this. And so this may not just simply be an issue of supply and demand competition, supply competition coming from South America. It may be political as well. So that is impacting our export sales, apparently. Ethanol demand for corn has remained strong. However, at the start of the year, it was a concerningly lower level compared to where we were prior years. But the February data still shows that we are stronger than years prior. So that's a positive on domestic usage. Moving on to soybeans quickly. Stocks in U.S. for soybeans was up slightly compared from last year. This is interesting because the December stocks number was down slightly from last year, and now we're seeing the March number was up slightly. And you can look at the chart on the right. That is total disappearance of soybeans is down from last year. And I think we know the story there. Again, it comes back to China. Again, a lot of export competition coming from South America as that new crop comes online. But at the same time, we have this political issue that's just hanging over the marketplace. Are the Chinese really stepping away from the United States just because they have more availability of soybeans in South America, or is it something else? And that's something we need to really take a look at. Apparently, the Chinese are signaling that indeed this is not just about supply and demand. They are not happy about the political situation as it is with the United States, and they are therefore sending more of their demand south. The positive story here is that crush capacity continues to come online in the U.S. That's driving U.S. soybean crush to new record highs. Almost every single month we're seeing a new record high, and that's driven almost entirely by the new demand for renewable diesel. I encourage you to look at our report that we just came out with here recently on our outlook for soybean crush. Moving on to the soybean products here, phenomenal increases in soybean meal exports and soybean oil imports, and all vegetable oil imports record high last year. And that's what you would expect, again, as vegetable oil demand continues to go up to feed the growing demand for renewable diesel. This is keeping a lid on soybean oil prices. Moving on, as we transition into wheat here, last couple charts here on soybeans. The crush margin for soybeans has really come off the peak. As you can see on the chart on the right, it's come down quite a bit to something that's more of a historical norm, just under $1 a bushel. And we know why. If you look at soybean meal and soybean oil prices, they've come back quite a bit over the past several months. Again, record imports of vegetable oils like canola oil flowing in from Canada, palm oil coming in from Southeast Asia, and then the big controversial import, and that is used cooking oil. Is it actually used cooking oil? A lot of these imports for used cooking oil coming in from China are suspected to actually be palm oil. That's a problem. Palm oil is not supposed to be used for renewable diesel because it contributes to the deforestation of rainforests in Southeast Asia. So we'll see what happens there. But these imports are depressing soybean oil prices, and that's helping the crush margins come off their peak. Moving quickly on to wheat, and then we'll hand it over to my colleague Jacqui Fatka to talk about her expectations this spring. Wheat prices continue to be under pressure globally for all the things we just talked about. A strong dollar. We've got strong competition for corn, an abundance of corn in the U.S. that competes for wheat into the feed channels. And then we have a lot of cheap Russian wheat entering the marketplace as well. Wheat stocks last quarter were up slightly from last year. Usage is down slightly for a couple of reasons. We have an export pace that is struggling to keep up. Exports so far this year are up slightly at 3.3% year over year. So that's been the positive here. The problem is HRW wheat grown in the central and southern plains, that's down 27% year over year. That is really hard to look at. And what's going on there? You have Mexican demand is really off the peak. Mexico's our #1 export market here. And so why is the Mexican demand off the peak when they've been so strong with importing spring wheat, as you can see in the top right chart, or corn, as we saw earlier, huge imports of corn into Mexico. Why are they stepping back so hard on HRW imports from the U.S.? Again, it goes back to Russia. Russia has been very aggressive sending wheat into our backyard, into the Mexican market. And so as a result, we have suffered from that. Here in the U.S., domestically, the amount of wheat milled for flour is also down. We're at multi-year lows. As you can see, the number of the bars on the far right of this chart for 2023. We're well off last year's levels for a couple of reasons. Bloomberg came out with a story here recently about consumers are really cutting back on how much snacking they're doing. And we're talking about the cookies and crackers and cakes, things like that. Consumers are cutting back on that because of inflation. But now we've also have this new interesting dynamic, Ozempic, the weight loss drug. One wouldn't think that a weight loss drug would have that much impact on demand for wheat, but it is being thrown out there as a potential reason why consumers are cutting back on snacking items, and that means less demand for wheat. Specifically, that means soft wheat. Soft wheat tends to be used in those, I consider them crumbly baked goods like cookies, crackers, and cakes. The wheat condition, or the condition of the U.S. winter wheat crop, is much better than we were last year, thanks to the El Nino conditions. However, we are concerned about where this goes in the months ahead. We are quickly transitioning out of El Nino, and into La Nina. And that would not be good typically for the central and southern plains. So although conditions are doing very well right now for the winter wheat crop, we have some concerns about where this may go in the future. We need a healthy wheat crop this year because we have so much wheat in storage, as we saw at the beginning of my section about farmers owning wheat in commercial storage, a lot of that has been degraded over several years. It's been held in storage, and so we're going to need some high quality wheat to help blend out that low quality old crop. And before I transition over to Jackie, these are the USDA's latest numbers on prospective plantings. You can see there at the very top blue line, corn acres expected to come down to about 90 million acres as soybean acres come up to about 86.5 million acres. We'll see how this plays out in the weeks and months ahead. Corn and soybean plantings are already in the very early stages. We're seeing that in the Southern Plains. It's like in Texas and the Delta and those areas. But any market development or weather development can change this. We'll have new numbers on this when USDA does their next survey in June. And with that, I am going to hand it over to my colleague, Jacqui Fatka, unless there are any questions.
Tanner, before we move on, question came in. Do you know for your commercial storage slides there, the borrowing base information, was that, what month did that end at? December or January, February?
That was January data. That was January data we had on the screen.
Okay, thank you. All right, sorry to interrupt, Jackie. Take it away.
All right, well, we're going to get a little more colorful here as we are hopefully heading into spring. And I already see a few questions coming in, and we're going to talk a little bit more about weather outlook. And as we head into this season, we have some good information as we've had some recent rains here. And I pulled these two charts. We had our spring outlook that was released here on the left on March 21st. And as you can see, we had quite a few of those key growing areas in upper Iowa, Minnesota, Wisconsin that are in that dark brown area. And then just 10 days later, they actually updated this drought outlook for the season with a lot of that area disappearing from that drought persisting or the drought developing likely. And so good news as we head into this growing season. I think a lot of people were, and we're going to talk about this more too, what we had from last growing season as we look to what 2024 can hold. And so again, on the drought monitor, you know, at one point, I think the number was about 20% of the country heading into this growing season was going to be in a drought concerning area. This chart on the left was just a chart that I picked from last fall, right? We knew coming out of last year that we had some extreme drought area, you know, that dark red, that very dark red there down in the south particularly, but those key growing regions in upper northeast Iowa and some of Minnesota and some of those areas in Nebraska and Kansas. But as you look at the right, and this drought monitor map is updated every week, this was from last week, and I would imagine we'd even see another improvement from a map if I was to pull it tomorrow. But some of those key areas, we finally see some improvement, right? So lighter drought possibility, which is definitely good news as we head into the spring. But within that, you know, we've got drought, but then we also have soil moisture. And I think definitely too, as we came out of last year, that was one issue. I grew up in that lower corner of Iowa and Southwest Iowa, where it's pretty red. You know, my dad still farms, my brother, those concerns about soil moisture are very real and concerning as we head into the growing season of whether there's enough moisture down there. But I currently live in central Ohio, as you see over in that area, lots of blue, lots of green, plenty of moisture, plenty of water to pull from. And as you look across the US, some of those central region areas and the Midwest growing areas, we do still have some soil moisture concerns. But as we head into, you know, going back to those drought maps and the projected drought, we know that April we could have some relief. But again, whether we transition fully from an El Nino to a La Nina, whether we have some neutral period in between there, that's going to be really important to watch as we look at some of these areas, whether we'll get more moisture heading in. So going back last year too, this was an interesting chart that was put out from Farm Doc Daily and another good research paper that came out last week, kind of detailing more of this too. There is this last year we kind of were able to manage some higher yields on the Eastern Corn Belt. We saw a big increase in Indiana, Ohio, Kentucky, but you see there that we did see some drop in some of the Iowa, Minnesota, South Dakota. And so overall, you know, our US total was down 1.9% for the corn yields last year. And most of that was because we had a good planting season from the sense that we got planted acres in. So we didn't have any rain delays that kept us out, but we all know that the heat index was higher in May and June and it dried up. There was no water to to replenish that corn. But July we had some favorable weather, and so we really saved our crop last year in July because of slightly cooler temperatures, and then also too we had slightly cooler temps and more precipitation that happened in July. So as we look towards the next couple of weeks, the calendar has turned to April. Outside my window, it is still very cold and dreary and lots of rain here in Ohio. But as you look through the central Midwest, tractors will be going. There's planters going. I'd love for anyone here that is on the chat to tell me if you guys have seen some planters going or if you're hoping to soon, because we do have some favorable weather coming here. And again, this is just the next couple of weeks, but the other concern when you have an early start to spring is whether you end up also having a late cool streak that comes behind it. And so far what we're seeing in the models, we don't see that coming. So that is, again, good news to hopefully get an early start on the spring, good planting start to really establish a strong season for the year. So we're going to go to our second poll question right now. And, you know, this is, what do you think farmers are most concerned about? Lower crop prices, obviously we talked about that up above with Tanner's discussion, higher input costs, environmental policy, farm policy, rising interest rates, or availability of inputs. We'll give you just a few little bit time to see where people think there. So we got quite a few folks coming in, leaning pretty strong towards kind of overwhelming, just similar to what Rod had for his. We'll give it just another little bit more, and then I'll show you. This is actually an exact question that CME and Purdue University asked in their Ag Barometer, and so we're gonna, out of our answer is clearly the lower prices, but that's actually not the highest ranking for the CME, so we're a little different there. You know, what we're seeing here, obviously that is a concern, but higher input costs continue to weigh, and these are related, right? You know, we know that we have lower crop and livestock prices for farmers, and so how they're going to deal with those lower prices in conjunction with a higher input cost is probably related to each other. But as we look at the beginning, Rob started off our discussion about the rising interest rates, and I think some of the concerns about the rising interest rates have probably diminished some. These bars represent a year view, so each of those bars is a different month within the last year. So you've seen things fluctuate, but still very you know, telling about the concerns that these higher input costs are having on producers and how they're going to manage these tighter environments. And I will also say, in my past life, I've done a lot of writing about the Farm Bill, and apparently no one cares about the Farm Bill or environmental policy, which is probably also why we're not seeing everybody driving tractors in DC right now asking for a new Farm Bill like they are in Europe, asking for changes to their environmental policy. So back to those production costs and what they're doing in the higher input cost. And this is from USDA's data that they had out February 1st. As you see, the top bar there is what we saw in 2022. 2023, that yellow bar is the forecast for last year. We will get the final forecast numbers May 1st. So here in a couple of, not the forecast, we'll see final input cost averages for 2023 here on May 1st. But we do see a little bit of relief in rent and fuel, but then some of those bars that are higher interest rates are just a tick up. Pesticide costs are a little higher this year than they were last year, but slightly below 2022. Fertilizer costs, same, right? We saw them pretty high in 2022 and then down in 23 and then back up again. So, and I see someone here, Tom said that labor availability is a top concern. Labor costs continue to be an increasing amount of the money spent at the farm level as well. So farmland values, and this is another survey question that the CME Ag Barometer puts out. And this is actually, do farmers think farmland values will go up? And as you look at that far right bar, this is the most recent month, we're seeing farmers anticipate that farmland values could be going higher. And so specifically 38% of those who were surveyed said they expect farmland values to increase in the year ahead, compared to just 31% who said they expected it to increase here the last two surveys in February and January. And as you go back to those interest rates and how they impact farmland purchases, the Kansas City Federal Reserve Bank, they put out this, and as you look at the value of that land and how you make your cash flow, when you look from 2002 to 2022, we saw that you see that dotted line there where the real estate values were well above the cost of financing. But then last year, as those interest rates started to continue to increase, we saw that land value appreciation flip, right? So farm profitability is really going to determine whether farmers can decide to pencil out that purchasing of the land. And remember, so much of farmland purchasing is what happens with proximity, right? A lot of farmers are always looking for that farm that's right next to where they already have some land. And so sometimes it is a matter of whether the proximity works. And when that land comes available, right now it's costing a lot more to finance that land. So again, back to those other input costs, fertilizer costs as it compares to the overall share of total cost, we're seeing that change here as we are looking to 2023 numbers. Again, the 2022 when fertilizer costs were high, we had it fairly high, not as high as the peak in 2008, but again, as we heard the numbers from Tanner on where farmers could be planting, we saw a decrease in corn acres, and a lot of it is because of the high production costs that come with planting corn. And again, we've seen some slight variances in cost for fertilizer heading into this spring. Last June is when we hit the low there of where we saw the weekly North America fertilizer price index. But as we've headed into this spring in the calendar year, we came into 2024 with some good opportunities last fall for folks to apply some of their fertilizer needs. And so we came in with pretty tight supplies and some supply hiccups along the coast to coast of trying to get fertilizer where it was needed, when it was needed this spring, especially as we saw a really nice February for temperatures. And so some folks were getting out into the field and doing some things. And so we've seen some tighter supplies on some fertilizer, but we've seen that also kind of go back down here in the recent weeks, and especially now as we head into the final planting. If you don't got it on, you're not going to probably get it on now for some of those applications. And so with that, I'm actually going to turn it back over. I know we've had a few questions that have come in, and so I will turn it back over to Rob and Tanner and I for any questions that people may have.
Hey, Jackie, I question here about essentially La Nina effects in leading to a wet June for your Corn Belt states, essentially. Um, I thought La Nina was more a drier effect. What?
Yeah, so La Nina is drier. What they're watching right now is the coolness of the waters out on the, over on west of California. But yeah, La Nina usually brings with it drier weather. El Nino usually has wetter weather. And I didn't include it in this, but Tyler, if you email me, I'll send you a chart. There's a chart that I've got that kind of shows a variation in yields on those La Nina years. The bigger issue that I think they're really watching with La Nina is how it impacts some of the Central Plains, some of the Texas area, and whether that dryness will push up from that maybe into the I states. And so that would be as we look at other La Nina years, I believe, and maybe Tanner correct me, I'm pretty sure 2012 was a La Nina year. But I don't have that right in front of me. But again, I think the bigger concern would be some of those southern Central Plains, Texas area, and whether that dryness would inch up into the main I states.
Okay, so reminder, you got a question, put it in the chat there. We'll take a look. There were a couple questions we didn't get a chance to before, but now I can mention them. There was a question, essentially, I think it got to the gist of it was, what's the 3-year outlook for the US dollar and what the effect on commodity prices are? And the US dollar has generally been trending stronger for the past 11 years, and I wouldn't look for any sharp diversion from that. We're going to still have a strong dollar. Whether or not it declines marginally or increases a bit, that's obviously up for debate, but I don't think it's going to have a huge boost to commodity prices. Couple reasons. US economy is still strong relative to others, and I anticipate moving into 2025, 26. I outlined my view that the Fed is looking for a big expansionary period in the economy, moving forward in the next few years. I hope that happens. That's probably the base case is for a good economic outlook. That happens, the dollar will remain strong. Probably interest rates will remain higher for longer, as everyone was saying. Geopolitics still very concerning all over the world. That means the US dollar is a great insurance policy for bad things happening. So people still want to hold the dollar. And one other thing to note about commodity prices right now, usually, as you know, commodities and the dollar move in opposite directions. So when the dollar strengthens, corn prices go down and vice versa. And that holds true for other commodities, oil and so forth. But right now we're kind of seeing a split with the general outlook for the global economy has improved over the past quarter, let's say, and Europe is coming in stronger than we thought. China doesn't look maybe quite as bad as it thought. So we're seeing appreciation in several of the commodities, particularly oil, copper, some of the other metals, but we're not seeing that in the ag commodities. So that is something to keep an eye on. Maybe there's a delayed reaction or something, but we may start to see an improvement in global demand for the ags. let's see, interest rates versus housing, which is similar to what Jackie was talking about with farmland. Obviously, higher interest rates makes buying a house much more, not marginally more, because it's a 30-year mortgage. So those interest rates are a huge portion. The majority of your monthly mortgage is actually an interest rate. So what these high interest rates have done is really shut down the housing market, dampened new house starts, builds. So it's really counterproductive. A lot of our inflation is being caused by housing costs. Well, high interest rates lead to a shortage of supply, which leads to higher housing costs. So the Fed is kind of in a pickle there, and that's one of the reasons I think they would like to lower interest rates. All right, what do we got here? We talked about this one internally. Tanner, do you want to comment on that? Essentially, the gist of it is in USDA's projected plantings, we came up short 2-3 million acres that just kind of disappeared from last year. Where did they go?
Yeah, on the whole, all acres combined, we lost 6.3 million. And they include all the crops, all the feed grains, corn, oats, barley. They all lost acres. Wheat lost winter wheat acres, obviously. And when you look at the breakout by state, it kind of progresses as you go south through the plains, Kansas, Oklahoma, Texas, those areas. And yeah, probably CRP and fallow as well. Probably both of those are increasing, but my bet is probably CRP. It's going to be low cost, and you've got a guaranteed rental income. So I think in this depressed environment, obviously on the plains, Kansas and Texas are the big CRP states, and so we're probably going to see those states lead on the acreage, and that's why we're going to see. That's where a lot of that disappearance is going to be, I think. But fallow probably in some areas as well is going to increase.
All right. We got, what would you expect reverse in trend in labor participation? Is the trend since the Great Recession due to baby boomer retirements, or what is the cause? No, this is a percent of the ages between, I think it's the one that I looked at was 16 to 65, I believe, was the ages. So that boomer retirements, that's not included in the percentage. What I'm showing you is the percentage of people that are of working age and those that are working. So it's been a decline in working age people that are working less. And it actually, economists pretty much have no idea why this is. I have, nebulous thoughts about kind of dysfunction of US society with more, opioid addiction, more just general malaise, depression, drug abuse, dissatisfaction, just throwing in the towel with life in general. And, there are some, disability numbers are up. So there's some people transitioning to, being disabled. So, that's one contributor, but really economists don't know why this is. It's probably, we lost more manufacturing jobs through time. And, if you were a tool and die maker, it's not so easy to become a receptionist at a restaurant or something like that. So there's been a transition. It's tough for people to make severe changes in their occupations. Jackie, you were going to say something?
Yeah, so another big thing on the labor picture, we do have a lot of those prime aged males, probably, as Rob said, because of the opioid and mental health, but the boomer generation created a lot of wealth, and they are now transferring over a lot of that wealth to this new younger generation. So, and I believe it's $67 trillion worth of wealth that they're going to be transferring over. So that incentive for this younger generation to work is also not necessarily there. So, there is a different generational makeup that is in the workforce today, and their desire to work is lessened because of all this money that could be transferring soon.
All right, projection for long-term interest rates will they remain lower than short-term rates. So I would guess by the end of year, earlier next year, we should have the yield curve should revert to normality. We get rid of the inverted yield curve. Long-term rates are going to stay relatively high in the 4% range, give or take, over the next few years. What you're going to see is the near-term interest rates are going to eventually fall to that 4% or lower level within the next 18 months or so. So that's my wild guess on that one. Are higher interest rates driving up the cost of home building itself? Yes, definitely. It takes a lot of capital to build a house. Obviously, it takes however many 6 months and labor, land acquisition, and so forth. So yes, there are direct. I don't have the specific numbers, but there are direct consequences to the cost of housing, not only the cost of borrowing to buy the house, but the house itself. What else do we got here? Increasing price of gold, trying to send a message to the Fed and Congress. I don't know, because the thing is the US dollar is still tremendously strong. So globally, there's no or there's limited fleeing from holding the US dollar. And I don't, the gold thing is kind of a mystery. I have a wild crackpot theory related to there's so many Western sanctions going on all over the world. And one way to make a transaction without using the banking system and US dollar and so forth and other, it could be people are just reverting to trading weapons and drugs and whatever with gold. That's my wild guess. So yes, that's what I've been trying to say. Yes, logically, higher interest rates are driving housing inflation, not solving it. That's exactly correct. So that's one of the reasons I said the Fed would like to lower interest rates despite the inflation still being a little above what they would like. Tanner, you want to tackle this one? Do you view the fund's net short on corn and soy a chicken and egg counterpoint to farmer-held on-farm inventories? Are the funds focused on other variables in their large shorts?
Well, the funds are trend followers. And so when prices fall, it's profitable for them to own a short position. And so that's pretty much what they do. When the trends, if they fear that those positions are not going to make them any more money, then they're going to get out of them, which I think explains why you're seeing the trimming of that short position as we head into the spring. But really, it's all about the funds follow the trends. If the trend is to the downside, the money is owning a short position. And so that's really what it's all about.
Okay, thank you, Tanner. We have 1 minute. I'll take one last question. And then also you will get I know someone asked if this was recorded, and probably tomorrow you'll get an email. If you're registered to this, and you probably have, considering you're listening, you'll get an email that will explain that. And of course, my phone here is ringing. But are foreign migrant workers included in the unemployment and labor force participation data? Some of it, yes. Some of it, no. But that hasn't been the big driver over time, because immigration has been quite strong over the past 10 years or so. So I don't think that that's what's caused the abrupt, um, shift. It was the global financial crisis was just devastating for the U.S. economy in many ways, the worst financial crisis since the Great Depression and obviously 1929. And it took nearly 10 years for us to kind of get back to some sense of normality. And a lot of those people just fell out of the workforce and never returned. That's the biggest chunk of it. But, why can't over time, we're going on 15 years now, why can't we get back to where we were? I don't know. I don't know. So with that, so there's our emails, all of us there. Please feel free to shoot us an email if you need a source or data or follow-up questions. Happy to do that. And tomorrow, our quarterly report will be published, and you'll see an email for that. And please look at that. The quarterly is much more detailed. I have an interesting spotlight article on U.S. trade policy, how it affects agriculture. Look for that. We've got all sorts of, I think it's 18 pages of material there. So, and with that, thanks so much for joining us, and we'll see you next time.